All right, good morning, everybody. So Amazon knocked it out of the ballpark last night, kind of reshaped the market just a little bit. Doesn't seem to be sticking, but it's a good start. You can see we got a lot on the docket today. A lot of it's earnings and payrolls. So the earnings are going to continue, but we're getting, we're winding down pretty good. Right now it's non-farm payrolls, hourly earnings. These are impactful from a number of ways, but it's one of the dot plots that the Fed uses, right? And remember, everybody's trying to price in what they think the Fed is going to do, and that's part of the reason for the violence and the volatility. I did mention the other day broker gamma, and I posted an article in the Bullish Bears large caps room that is a really good read that kind of explains that in a little bit more detail. But basically, the way it works, if you buy an option, the market maker is not going to carry that risk, right? They're going to offset that risk because if they're the seller and you're the one that bought it, now they're holding a negative delta and they want to remove that negative delta. They go out and they buy stock. Well, and the way the article was describing it is once they're really, really exposed by all of this stock that they're holding and we start to get these extreme moves, it's them trying to readjust that positioning that they're in, and they have to go with the move. So as soon as the move starts to accelerate to the downside, they're hammering it to the downside because they got to go with the move. And then that just it makes the acceleration even worse. And if we begin to go to the upside, they have to jump in and really pound that upside. And that makes the upside move even worse. And that creates just more and more volatility. Volatility is the nerd word for movement. And so when we have implied volatility, then we have an implied movement. And when we say things like, oh, the implied volatility is going up, then we are really saying the day to day candle close to candle close is getting bigger or is expected to be bigger. It is implied that it is getting bigger. That's volatility. Nerd talk. There are some analyst estimates. What we really want to be watching for are surprise numbers. So be very careful on that. Going to be looking for shock and awe if they miss these numbers. Goldman Sachs estimate is a drop of 250,000, well under the consensus of the 150K. So some of these analysts are really wide apart, and that's the kind of mornings when we really see some shakeup. Usually, most of these guys are on the same page. They're thinking the same numbers, and their estimates are within a mean or a median range that isn't too wide, but not this morning. So just be ready today for a little bit of fireworks. So when we come into the market watch, we can see the 8:30, 10, and 1 o'clock is what we got left, and that's it. But I would argue that's enough, right? So the rig count, not really a big deal. It's going to be 8:30 and 10, and that'll be a wrap. We'll just try to get through the rest of the day. So I got a lot of junk on my chart. I understand, the clutter is kind of hard to get some grasp of what's going on. One thing worth noting was the volume yesterday. Right now, when we get down days, having elevated volume is normal. So, uh, looking at this volume here, what we didn't want to see was an exaggerated level of volume, right? A little bit of negative volume makes perfect sense when you have a down day, and this is what we're seeing, and that's fine, right? That's kind of what we want to see, right? What we wouldn't want to see is some massive blowout amount of volume on that downward day yesterday, because there's still the argument about, is this a dead cat bounce, or is this just a minor pullback after 4 days of a really strong run off of these lows? One of the reasons that we're out on the daily chart is because we're crossing back through some major moving averages. We came back underneath the 20 because we rejected off of it yesterday. We've got the 200 and the 10 right underneath us. Now, I mentioned it earlier that the weekly expected move for this week is just broken. It just doesn't work this week. And sometimes, a thinkorswim, that's just the way it goes. It's broken on the ES, right? Not on every market. So the distance of that expected move is just toast. It's worthless. So what we would want to do to get that expected move for today, and that's the only one that matters, is we can just go to the options chain and look right here. 54.19 is the expected move. That's 54.19 higher and 54.19 lower than our current location. But make sure you keep your eye on the market maker move, because you want to add that, right? So 54 plus 41. That's your expected move to the upside or the downside. And that's just the ES, right? And you take that and then look at something like our ADR for today. We got an average daily range of 2.3%. So the ES is going to be easily capable of tagging multiple lines through today's session. All right, green and blue. The green line is the 20, the blue line is the 10. So you can see that on the daily chart, when we were out here on the daily, that's the moving averages that we're looking at, the 20 and the 10. Well, if we plot those daily indicators on our intraday chart, then we can see it's right underneath our feet. We've already broken yesterday's low, so we're going to be considering that a broken pivot. When we go to interact with that, we're going to have the expectation that there's no more liquidity at that level. There's a difference between liquidity and volume. So there is now a volume node there. There's some volume support, but there's no more liquidity at that level. We've absorbed it and we've dealt with it. If we break back down below that, that'll put us on an inside day breakout. We'll deal with that 10-period moving average and aim for the cog line 44.11. These do translate over into SPY. So if you're, not a futures trader, but instead are an options trader, then you'd want to focus on the same levels for the S&P SPY or SPX, XSP, take your pick. Should the news get positive and we start to bounce back up again, we will resolve this move to the upside through our own Globex ranges, right? And we spent most of the night in a relatively decent range before it finally started to break down. So we're going to look to reclaim that 45.11 and then deal with the range of the day. We've got the 20-period daily moving average over our head. It's going to take a significant amount of market participation to get through that level. You can see how it tried to get through the level yesterday on the intraday. That move to the upside yesterday stopped right at the 20-period daily moving average. That's all it had, and it just couldn't get through it. So if we do start making a move back up today, that's going to be the target. We're basically flat on the day if you're looking at, change from close. But see, this is the kind of stuff that makes me want to throw Thinkorswim out the window. If the ES closed up here last night and we're down here now, we can't be at 0% change on the day, right? That just doesn't make any sense. So be cautious. Sometimes, messing with thinkorswim can be misleading. All brokers have issues at various times, and this would be one for thinkorswim. So let's get kind of a better idea. How far off are we today? We're down 1% on the ES. Let's see if my broker says that. Nope, my broker says the ES is flat as well. So why does it say we're flat? Well, it's recording where we went into the close at 4 o'clock. And because we went into the close at 4 o'clock down here and then we rallied, the machine is still thinking that that's where we closed. And so it says we're flat. But technically, we closed, at 5 o'clock, and that was way up here. The EM isn't broken today. It's been broken all week. Every once in a while, that expected move indicator will do something goofy when it comes to the futures, and we'll get one of these really, really wide boxes. Never trust a thinkorswim indicator to do its job, especially if it's a custom indicator. They can just sometimes go wonky. So look how just extremely nasty wide that box is. It's unrealistic, 100%. Right? And I pointed it out at the first of the week. If you go back and watch the morning briefing, I went into detail explaining why this was off and how you could mark your level for the week so that you didn't have to lean on this. And when I say lean on this indicator is designed for people that don't know how to measure this stuff for themselves, right? So this is the training wheels that we put on so you could pedal the bicycle and get around. The idea would be eventually you don't need the training wheels and you know where to get those numbers for yourself. Then you don't have to worry about a broken indicator. Where do you get those numbers? At that way, right here. And you want to get them on Friday night, Saturday, or Sunday. On Sunday before 6 o'clock when the market opens back up Sunday night, right? So after the close Friday, all day Saturday, most of the day Sunday, get your number before Sunday night, and you're good for the week. The reason that that's unrealistic and we want to use something like an indicator is because there's a lot of markets. I mean, you don't want to go through and mark SPY and SPX and QQQ, and the list is endless, and then you forget one, and it's Monday morning and you didn't get it marked. Well, then we can turn on an indicator, right? But there are a few that are really important, like the ES. And if it's acting stupid, then we go in and mark our own lines and we say, screw the indicator, right? You can see how next week's are already plotted and they're back to normal. So it's not broken next week. We don't have to worry about it. So we're in the pinch. We're in the pinch between the 10 and the 20. We're getting a little bit of a squeeze between those two. And when I say squeeze, I'm not talking like the squeeze indicator, right? So don't correlate those terms in your head just because the word squeeze was used. The other lines that you see here on my chart, this green line and this red line and this green line and this red line, the shaded area is today's implied move. And then this is, or let's say it this way, that's the probable move. And these other two lines are the implied move. So the square root of time says we could go as high as 45.78 or as low as 44.50. But it would be more likely if we moved in a range between 45.34 and 44.93. Right? So implied moves and probable moves. For the Nasdaq, same thing. You can see we're in between the 10 and the 20. We are resting on that 10 period moving average. Kind of held us up. Clean up some of the stuff there. Notice the weekly expected move. We left it earlier in the week. We came back down. We're now back inside the box, and we're very close to being where we started the week. Right? That middle line is where we closed last Friday, and we're working back down towards that level. Now, notice the NASDAQ is up 0.5%, and this makes us believe that we've got a bifurcated market. but do we really have a bifurcated market? Well, if we're looking at the close at 4 o'clock, or are we looking at this close up here at 5 o'clock? So a big distinction. One way that you could do it is just look at where we opened, because that would be fair. If you look at the open on the ES and you look at the open on the Nasdaq, and then you draw the line, where are we? We're underneath the open 1.29%, because when the market opened last night in Globex, we went down. So, we're not up a half of a percent, we're down 1.25%. This is why it's important to check the numbers and understand what the broker is showing you, what time frames they're using to get their math, so that we just don't see a number like that and think, oh wow, the Nasdaq's up and the S&P is down. No. So for today, we're going to look to reclaim our levels and move back up and challenge that purple line if we have good numbers. If the numbers are bad, we're going to break back through that 10 and begin moving to the downside. We do want to check the volume to make sure that there's no volume profile in our way, right? And you can see how we're in that shallow area. Well, when you're in the shallow area, you can move through the shallow area relatively quick, like we did back here. Quick down and quick right back up. Well, you can only do that so many times before you fill in the shallow area, and then it's not shallow anymore, right? The more time we spend moving through that market. We got the volume support of the volume node underneath this market. And should we break that, we have another shallow dip, and we'll be looking at 14,200 to the downside. That would bring us towards the point of control on the volume by time and the volume by price. Price is in green, time is in blue. So we left the box, we came back into the box. We're looking to come down to the lower end of the box to retest our point of controls. While I'm here, because we didn't look at it moment when I was on the ES, there's the ES levels. So 4420 has some support, and that's the box that we were in last week, right? Remember, we left the box. Everybody was excited. We're either going to get a Busby bounce, or that's not going to work, and we're going to dump back down and find our points of control. So watch your daily moving averages today. We are interacting with them, and they're very beneficial, right? You want to know when you're about to hit a major line in the sand. I did go to the CBOE website and get the most liquid traded products for January, put the list together. I'll be sharing this list out when I'm done with the stream. I've already imported it into TradingView. So this morning, we're going to be looking at those markets in a change percent. Now, TradingView doesn't give you access to your own watch list the way it does with the things in its watch list, right? If it gives you like the S&P 100, you can do a lot more with it. But if you make a watch list, the scanners and the things that you can do, not so much. So these are those January numbers. I haven't gone through to remove the ETFs and ETNs and volatility or any of that stuff. I just downloaded it. But when we sort it by after hours, then we can kind of see, what's up this morning, what's down this morning. Ford, after its earnings, it looked like it was going to stay kind of sideways, and then it just, because they did miss, but they didn't miss in a horrible way. Citigroup, General Motors, Visa, we got a lot of finance names up there this morning. And these are all on the negative side. And remember, when we're looking at the negative side, or on either side, really, we want to see it at least a half of a percent. So, like Goldman Sachs is down at least a half of a percent. So we got the S&P 500. We want to change this to pre-market percent. Use the filter, kind of knock the names down to around 100 names. It's not really very easy to do. 113 is close enough. Kind of group them a little bit change their color scheme, and now we've got a better understanding of what's moving around in the pre-market. We are in a risk-off situation. Energy is looking really good, and the energy is the talk of the town outside of the payroll numbers, right? And I'm looking at the watch list. It just turned green across the screen. So we're getting a significant move in the market while I'm talking, right? Well, that doesn't look too significant. You know, that's the crazy thing about the size of these day-to-day swings. We're getting moves of, 1 minute candles 50 points wide, and we say, is that all? Just 50 points? Oh, that's not that bad. So look for that rotation to be coming in. Follow the sectors, use those as your opportunity for trading. I've been warning a lot of people that if you're new to trading, that this is an extreme environment and you want to be very, very selective of your swing trades that you're taking. Right now, when it comes to day trading, by all means, have a blast, get your trades on. There is plenty of opportunity, but for swing trades, really kind of dial that back and be cautious. Use a hedge if you're going to be carrying a lot of swings so that if the market does make an extreme move against you, you're not wiping out half of your account, right? Try to stay as diverse as possible, not just in the products that you're trading, but in the direction that you're trading. Have some that are long, short, sideways, right? Spread it out as much as you can. Different sectors, different industries, different directions. That way, you will always have something working in your favor. We just put on some new swings last night. We sold the MES put and we put on some Amazon earnings trades using just some credits. No, debit spreads is what we used. So we're looking at the Nasdaq 100 pre-market change percent. We don't need a filter, but we want to adjust the color scheme. Got a little bit of green on the screen, including Amazon with an 11% move this morning. The EV market is moving around, getting a little bit out of Tesla and LCID. And then looking at the stock screener, right? This is where we go in and we just adjust it by its percentages. How many names are down in the S&P? At least a half of a percent, more than 25, right? So we could say 25% of the S&P is down a half of a percent. We can check the same thing on the Nasdaq. How much of the Nasdaq is down at least a half of a percent? 20. Now the S&P has financials, the Nasdaq 100 does not. So when you're looking at what's down, make sure when you're on the ES side or the S&P side that you're looking at those financial names because you won't see them when you come over to the Nasdaq 100. Also, when you are looking in here, look at the sectors, right? Let that be a little bit of a guide to kind of lead you in the right direction. So these are the down names. Let's see the up names. Of course, Amazon, Fortnite, Datadog, right? We got LCID, some of those bigger tech names, Zoom, DocuSign. So IGV and Cloud, um, XLK, those look like they're going to be doing good this morning. And we've got 19 names that are positive by at least a half of a percent. In the S&P, we've got 10. And none of them are tech, none of them are finance. Remember, if we're going to get a really good move in the marketplace, we need tech and finance. We can do it with just finance or tech, but it's liable to give us a distorted marketplace, a bifurcated marketplace, and a choppy one as well. So we want to see them both. All right, so we got the sec list. Bitcoin up more than 4.5%. IGM USO, that's the a lot of energy in there, right? XOP, XLE, USO, we consider all of those a part of the energy market. Marijuana's up this morning. The Qs, so we got technology, cloud services, even the devil's metals up a bit. We got silver on a ride, gold right behind it. Emerging markets is just starting to turn green. We need that to really come in, right? That's our global perspective of risk. And then look at this capital rotation that's coming in, right? During this sideways move, we're seeing a lot of things like retail, not retail, real estate, natural gas, utilities, healthcare, things like that. Now those are the down sectors, and we're starting to see, technology, and I'd like to see finance, but it's not in the game yet. Very likely for me, I'm going to be watching finance as we come to the open, trying to pick my plays out of that, or maybe some energy if energy doesn't get out of control, right? I don't want to chase it if it's already out 2, 3, 4%. So, looking at names that have weekly options, we have a lot of names this morning that are on the run. Plenty of markets to choose from. I'm telling you, it's like a buffet of different things that we could trade this morning. The A morning like this, where we're coming kind of coming in off of a low, provides a lot of opportunities. But look how extreme this has been. We went into the low until 4 o'clock, blasted back up to the open of the previous day, held that through the most of the middle of the night, got into power hour, and or not power hour, but the kill zone, which starts at 2 and ends at 4. We got into that, and that drifted all the way back down to the 10, and now we're on our way back up again. It's crazy extreme, but take advantage of this momentum for some really good day trades, right? If you're going to see 3, 4, 5% swings on the day, take it. So you can see that VIX selling off, confirming that break to the upside. The bonds really haven't really started to absorb, and the dollar's just holding steady. Keep your eye on these two. Right now, I've been kind of bouncing back between the ZB and the ZN, between the 30 and the 10. But what we don't want to see is big exaggerated moves like yesterday, right? And you can see how those big exaggerated moves from yesterday correlated with our market. So we don't want to see that. We want to see just nice, easy price action through the day with the bonds not really rocking out. And same thing with the dollar. It's all right to see them move around. We just don't want to see these big, extreme, drastic moves, right? That's what I got for you guys. Be careful, be safe, and I will share the new watch list probably in a good 20 minutes or so. I'll put it in the large caps chat.